Back with some new numbers shining a light on the health of our economy.
Yeah, the core personal consumption expenditures price index, that's a mouthful, for September grew by 0.3% month on month and 2.7% year over year. The PCE is the Federal Reserve's preferred inflation indicator. My preferred way of saying it.
Joining us here is Investopedia's editor-in-chief, friend of the show, Caleb Silver. All right, so got some alphabet soup here.
Yeah.
All right. PCE, how does it differ from the CPI?
Yes, and great job by you, by the way, in pronouncing all of that.
Slow.
You're hired. PCE is the Fed's preferred measure of inflation because it measures the price of goods and services. CPI, the Consumer Price Index, that just measures goods mostly and gas and things we pay for shelter and stuff like that. So this is a more dynamic way of looking at the economy that takes into account what we're spending on just about everything. Think about air travel, think about the things we have to buy at the store, and guess what? It is growing at the slowest pace in quite a long time, up just 2.1% year over year. So that inflation target that the Fed has been hunting for, somewhere between 2 and 2.5%, it is here right now. This is the last piece of inflation data the Fed will look at before it meets next week, 2 days after the election.
All right, so some more specific numbers. Yesterday, we learned that the U.S. economy grew at an annualized rate of 2.8% in the third quarter. That was less than expected and lower than the previous quarter. What's going on there? Is that a point of concern?
Not really, because we're still growing. If you want to be concerned, it would be if growth was continuing to decline. And if you look at it on an annual rate, 12-month basis, 2.7% growth. So the economy is growing. There are more jobs out there. People have gotten raises in the past year, and prices are growing at a much slower rate. So this is the Goldilocks that Fed was trying to engineer. People may not feel it, but we're in a normalized state of the economy right now. Even things are more expensive. The economy is still growing, and prices are growing at a much slower rate.
You mentioned it. The Fed will meet 2 days after the election, regardless of whether we know who won the election at that point. What is it they're expected to do?
Yeah, you're talking about 7 days, 5 hours, and 18 minutes from now.
Yes.
They're expected to lower rates by 0.25%. And this has been the path the Fed has put us on since it stopped raising rates back in July of last year. And this is going to be a 0.25 point cut. Probably another 0.25 point cut at the December 18th meeting. The Fed wants to bring those interest rates down to a more normalized level, and that's starting to happen. You're not feeling it across the economy yet, but you are starting to see it in things like pending home sales, more car purchases. You're starting to see the economy open up a little bit because people are borrowing more as those rates are coming down.
It's interesting to hear you say, though, you're not feeling it. Like maybe you're seeing it, maybe you're hearing it when we have conversations like this. How do you think that not feeling it piece of it factors into, oh, I don't know, what's happening on Tuesday?
Just a little bit, because people, when they see inflation and they're still feeling inflation, they blame two sources: the government and companies.
Right.
Prices for companies for price gouging, and the government for maybe handing out too much money and causing inflation. So people feel that prices are still high. I was just hearing folks talk about how expensive candy was just to have for the trick-or-treaters. Prices are high. They've gone up a lot in the last few years. They are not coming down. They're just growing at a slower rate. So for folks who are kind of on that fixed income or who haven't gotten the benefit of a big raise, they feel like the economy is not doing that great.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app or follow us on social media.